We're so excited because we're in Tampa Bay for Sam Silverman's fully funded conference, a long overdue podcast episode with a very great friend and lucky enough to be one of the few partners he actually partners with. When he raised the amount of capital that this guy is capable of raising, you've got to do a lot of things really well, so we're humbled that we even get the opportunity to work with you. We're going to get into that, but thank you so much, our friend, the founder of Next Level Income, Chris Larsen. How are you?
I'm great. Great to see you guys. Always have a great time. Always lots of laughs.
Yes, lots of laughs,
Yeah.
lots of banter. We won't get into the specificities of it, but our text chain is absolutely wild this week. I wonder why. But let's get right into it. Let's get into you, your story. Before we get into the real estate, what you're doing now to be sitting in this chair, how did you get here? Let's go, the origins, if you will.
Yeah, thank you, Craig, and thank you, Rob. Like I said, great to see you both. So yeah, 25 years ago, in a few short weeks here, I bought my first property. I was in college, went to Virginia Tech, and we were talking just about a little bit about my cycling career before we started recording here today. And that was my dream. I wanted to be a professional cyclist. So I went to college. I said, you know what, being a professional cyclist doesn't pay great, so I want to at least get a good degree. So I went to school for biomechanical engineering at Virginia Tech. Between my freshman and sophomore years, actually my best friend passed away. And I raced for another year, but I started to think a year later during that following summer, like, I'm riding my bike around in circles, I'm training 20, 30 hours a week, like there's gotta be more to life. And I thought, if I died tomorrow, would I really feel like I lived a full life? And the answer I kept coming back to was like, I don't think so. I think I'm going to have regrets if I just keep going down this path. And I said, I don't want to have regrets. So I started to think about these things and say, well, what kind of life do you have to live to not have regrets? You have to, if I see a girl that's attractive and I'm like, I'm going to ask her out. If somebody says, hey, Chris, do you want to go like to F1 race on a Monday on this Friday? Like, I'm going to make that happen. Like, when I have these exciting things presented to me, one, I want to have the mentality to say yes, I want to be a part of that. Two, I want to have the means to be able to do it. And the fact of the matter, in the world that we live in today, the United States, tremendous affluence, but you have to have money if you want to take care of yourself. You want to eat the right food, take the right supplements, spend time, exercising and working out and doing those things. You want to send your kids to the best schools to give them the best advantage. You want to travel and do all these things. These things take money. So I said, okay, how can I be financially independent? I got excited about the stock market. So I started investing in the stock market, although my idea of investing back then was day trading. So here I am now, a junior in college, making $5,000 a month day trading. But some days it'd be 3 a.m. and I'd be laying awake in bed thinking about, like, what am I going to do? What am I going to trade? How am I going to do this? And I'm 20 years old and I'm thinking, I don't know if I'm going to live till 40, let alone can I do this until I'm 40. So I said, this isn't investing. So I started this pursuit of learning. I read over 250 books on money, business, finance, stock market, real estate. Ended up getting an MBA in portfolio management. And that same year, I bought my first property. And I said, real estate is going to be my path. And went from that first single family rental to making our first investment a little over a decade ago in the multifamily space, and then ultimately syndicating deals. And we've syndicated just about $1.5 billion in total deal volume since 2016.
Incredible. Yeah. So you did that. You got into your first kind of career path was the medical sales, correct?
Yes. So glad you came back to that. So when you're 21 years old and you buy a couple pieces of real estate,
you need more money.
You need capital. So you run out of capital, but you also run out of credit real fast. So I said, okay, I need money. And I read Rich Dad, Poor Dad. I was in a bookstore in Charlottesville in 2000. And this is back when I would just read books because I don't even think Kindle was out then, or it was really early.
Books
early.
On tape, or actually on tape at that point, or CD.
I got Audible. Actually, I had one of the first Audible memberships. That was kind of my cheat code to my MBA, because every morning at 6 a.m. I go to the gym, hop on the treadmill or lift, and I would listen to the Wall Street Journal kind of summary in the mornings that I got for free with my membership. So every day in class, I could talk about these things, and people thought I was a freak because they're like, how do you read the Wall Street Journal before class every day? It's like 9 o'clock in the morning. I'm like, hey, you just got to be dedicated, right? So
Yeah, the cheat
So,
code.
yeah. And he listened
Me,
to-
I was actually reading the Wall Street
That's
Journal,
right.
right? So I was an idiot.
Yeah. There you go. So, but you can only read so fast. It's hard to read on the treadmill. So, I read Rich Dad Poor Dad because I was in Barnes and Noble, and this guy was like, "Hey, are you looking for a book to read?" He's like, "You should read this. It just came out." So I read Rich Dad Poor Dad, and Robert Kiyosaki said, "If you want access to the best investments, you need to be accredited." So the next book I bought was Sales Careers Where You Can Make Over Six Figures. And I started thinking like, okay, I'd probably be good at sales. I started selling wrapping paper when I was 12. I had sold Cutco knives, which I talked about in my presentation earlier today.
Which was great, by the way.
Yeah, thank you, sir. A couple summers before that. And I like sales. And what I liked about sales is that you had freedom, right? You guys know about the sales career and how you could, that painting behind you, the chair you're sitting on, this glass that I'm drinking this water out of, little bitters in it. Everything's sold. Like there's a salesperson behind that. So it gave a lot of freedom and also unlimited earning potential. And I stumbled into the medical device space because I was selling insurance for State Farm. And my agent that I worked with said, "Hey, you should meet a friend of mine. He works in ORs. He sells like medical equipment." Took the guy out to lunch. He tells me he's making $350,000. This is 25 years ago.
That was, like what, 700K almost today?
Yeah, it'd be
so?
like
Probably more,
north
honestly.
of $500,000, right?
Yeah.
So significant money. And I was like, whoa. And I thought it was super cool because I have a biomechanical engineering degree, and he was literally selling the implants that I had learned how to design in my classes. I thought this is really neat. So I went down that path. I was successful in that. And I put together kind of the next level income strategy, which I talk about in my book. If people want a copy, they can get it at nextlevelincome.com and get a free copy there. But I said, I'm going to save half the money I make, and I'm going to invest it. And so that's what I did. Made a lot of money, was very successful in my career. But the big thing was I was working for the ability to make money to invest, to generate that passive income.
Yeah, and I think what it all goes back to why I got here to Lone Star, why I made my switch, is because you just need to get into the car that gets you to the I side, the investor side, as quickly as possible. Take a note out of the Robert Kiyosaki book. So however you can get to that chair, into that seat where your money works for you, is the place you want to go. And if I figured out the structure, the multifamily business, I was instantly hooked and was like, okay, well, let's do this. Let's go all in. So you basically wanted to invest, and then naturally you make your money doing the medical sales stuff. When did the capital raising, private equity, arm of things kind of come into play?
Yeah, so I mentioned, it seems like I've had some unfortunate losses in my life. I talked about my friend Chris dying and kind of how that kind of pulled me back. So I had my head down, building my career, get married, have 2 children. My wife and I are in Asheville, North Carolina now. My mom passes away at the end of 2011. The next year, I do kind of this life review again. I'm like, hey, what am I doing? Like, is everything going well? Can I change anything? Like, am I really making the most out of my time? And one of the things I looked at that year, Craig, was I said, my single family portfolio is generating like 7% return on equity. And that's before tax. So we're talking like 4%. I was like, this isn't very good. So I started looking at other options that were out there, and I was at a meeting having this same conversation. Hey, I'm frustrated with my single family portfolio. And so I said, you should meet my friend. They syndicate multifamily deals. So this was back in 2012, and just like literally a year after my mother had passed away, almost to the day. And I talked to them. I said, whoa, I can double my returns or better, make more money with less effort. So invested in my first multifamily deal that following year. I'm actually
that was 2020 or 2012?
It would have been the following year, so it would have been 2013.
So what a great time to
very good time.
Yeah.
It's very fortuitous, but it's funny what happens, how lucky you get the harder you work and the more you educate yourself, right?
Exactly.
Yeah.
So, and I'm a demographics guy. So if you look at my investment thesis and you work with us, you'll hear me talk about demographics and real estate cycles. I look at these bigger trends that are out there. So the more I learned about multifamily real estate and the trends behind it, you have millennials investing. You have millennials renting. As we've seen over the past 5 years or so, you actually have the baby boomer generation renting in greater numbers.
Well, the average homeowner or home buyer right now is 56 years old.
Wow.
That's
Interesting,
a
yeah.
very
Yeah.
morbid statistic for many reasons because
Yeah.
homeownership, in my opinion, for a lot of people, is your path to actually having a really good long-term life and retirement and being comfortable in many respects.
Yeah. Yeah, no, and it's, look, being able to, buy a house and learn kind of that forced savings is very important. And there's multiple ways you can do that. But yeah, home ownership is highly tied to wealth and generational wealth in a lot of ways. So, as I saw these rental trends and I saw the lack of housing, that and the amount we need to build coming out of the, Great Recession, and now the affordability crisis that we're trying to solve here collectively with some of the things that we do, I said this is a great space. It's the same reason I got into the medical device space was demographics. Baby boomers, the most affluent generation in our known history, living long lives, want to be active. That means they're probably going to have orthopedic surgery when they have a bad hip or a bad knee or they have a back issue, which is what led me down that path. And what happened was after investing in that space for a few years, introducing some people, a good friend of mine at the time, excuse me, that had invested with the same group, ultimately said, "Hey, I'm gonna retire." And he had an inheritance that was given to him. He's like, "I'm gonna quote unquote retire." Then a year later, he said, "I'm gonna buy an apartment building. I want you to be my partner." So that was in 2015. We closed our first deal in 2016 in August 2nd, 2016. And in Smyrna, Georgia, right next to the new Braves Stadium that's down there. We ultimately acquired 5 properties in the Atlanta market. And then that was between 2016 and 2019. And then we started to diversify, branch out from multifamily about 5 years after that.
Very cool. So you got in the multifamily space, you start investing. When at the raising side of it, because he was your partner, so did you raise capital when you made that transition to being his partner? Were you doing medical sales at that point? Did you have so much invested that you didn't need to? What was kind of like that crescendo of things going on?
Yeah, that's an excellent question. So I think one of the things I found, I talk about this with my coaching clients, is that we have a certain mentality in this country, and even I would say as men, like we tie our identity up with what do you do? How much money do you make? These sorts of things. And we pursue this path that we're told is success. And sometimes, just like I was saying, I had my head down pursuing this career, and then when you pop your head up and you look, you're missing so much that's going on, and you forget that there could be a better way. I think one of the reasons that we have, it's called like a midlife crisis, is that we get to a point and we've done all the right stuff. We have a successful career. We're making 6 figures. We have the luxury SUVs in the garage. We live in the nice neighborhood. Our kids are in the private schools. We're not happy. Well, happiness actually is on a curve too. It drops into your 50s and then it rises back up. And that drop starts in like your late 20s. I think if we're aware of these things, we can kind of combat some of these issues. But I got sidetracked there a little bit. But if you don't stop and think, okay, like what am I ultimately doing this for, then you're probably not going to be happy. So I had enough passive income to not work anymore, but I was like, I'm not going to be happy not doing anything.
What age were you at that point?
Yeah, this would have been 2016.
So you're basically
So I was,
at that point like 30. Yeah.
Yeah, I wasn't 40 yet. I was 30, probably 38.
Yeah.
But close. Good.
Yeah. So 38.
Round nose. Yep.
And how much were you investing out of curiosity? Just for like those, like a
It's like your son Miles.
That's right, exactly.
So, Dad, what is this?
So, like roughly, what were you investing like an annual contribution to get to that point? Because I think so many people look at the world as, okay, I need to put so many dollars of contributions away, and then I can have this freedom.
Yeah.
And then what's next, right? But how much were you, kind of contributing and things of that nature?
So we had, I'll reverse that so people can figure that out on their own. But we had no debt aside from our home, and we bought a house, and our mortgage at the time was about $1,400 a month. So our living expenses for a family of 4 were about $5,000 a month. So not very much. So we had enough passive income coming in to cover.
That sounds like pre-COVID, if I've ever heard of it.
Yes.
Yeah, but hey, if you live in like a nice, and again, we bought the house in 2009. We made
right after right after the spike
during,
down.
yeah,
Yeah.
like at very low point in the market. So I was like, hey, we comfortably had $5,000 a month coming in. So I was like, okay, this is fine. But we wanted to build a new house. We wanted to do some things. I said, okay, well, how do we keep growing our wealth? My wife's an architect. She wanted to keep working. I said, well, what do we do from here? So I took a role. I actually left my really high stress sales role because I was on call for 12 years of my life, and I worked. I couldn't even tell you how many hours I worked, but there were days that I worked 7 months straight one time, no days off. I spent 3 nights in a row in a hospital, like working, so you can, I worked around the clock. It was more of a lifestyle to do that. So I left and I was managing a distributorship when my partner came to me and did this. So I had a little bit more of a managerial role. I was still making really good money. So he handled more of the operations. So naturally, I started to fall more into the capital raise and the investor side, Craig. And my skill set from being in sales, as you can relate, Craig, fit. And it was easy because I went from dealing with high stress surgeries where patients could be maimed or potentially die if something went wrong.
And courting surgeons is not an easy job. There's a ton of competition. I've got a ton of friends that work with Stryker.
Yeah.
So courting surgeons, basically you are a commodity at the end of the day. You want to work with a market leader. You want to work with a good brokerage, my case. But it's not easy to cut through. So you've got to be really good, really charismatic, and be on your shit. Pardon my French, but on your game
you're right.
to attract and get business in that sense, which is probably one of the best complementary skill sets to raising capital because it's a very noisy space.
Absolutely.
There's a lot of competition out there, and what do you do to distinguish yourself, right?
Yeah, and I think also, and you all know this because Rob, you've built a tremendous team with the right people in the right spots. Going back to what you were just saying, Craig, if I'm in the room with a neurosurgeon, right? That guy's smarter than me, most likely. I wouldn't want to work with any surgeons that were not smarter than me. I mean, these are geniuses.
Yeah.
These are the top of the top. Neurosurgeons, cardiac surgeons. These are the best surgeons that are out there. Typically.
Best and the brightest in the world.
Yeah, they're making the most money. It's super high stress because it's like brain, spine, heart. Like the patient's going to die if something goes wrong. With all due respect to orthopedic surgeons I work with a long time. You can cut the leg in half and you can kind of get it close and it'll heal back together. But you cut a nerve in half, that's it. Patient's done. And I'm being super simple. So if you're a surgeon, you're listening, know that I'm saying that on purpose. But neurosurgeons, heart surgeons, these guys are top notch. So that doctor is not necessarily going to be the best at, say, running the hospital as an administrator, right? Like the administrator is going to have a different set of skills. The woman that I shouldn't say the woman, but the female nurse, right, that has a certain way of being able to communicate with a patient, has a different bedside manner, probably is going to be better than a surgeon that is just trying to get in and do that job and doesn't really care about how he comes across, So you want to have the right people in the right spot and do that. And what I found was, given my background and what I enjoyed doing, I love looking at deals. I love analyzing deals. But I also love conveying my framework about investing in deals to investors and explaining how it could benefit. But also, I think that one of my skills is analyzing someone's situation, help them put a strategy together so that they can ultimately get where they want to be. And certainly my financial background also assists with that too. So it was a nice blending of skill sets and experience that ultimately led me more towards the investor side.
So you get into the investing side, you acquired those properties around 2016, you mentioned, in the Atlanta area. So then you started there. Are you with that person still to this day, that person you did partnered with? And then, okay.
Yeah, no. Unfortunately, that partnership didn't work out. We had some success early on.
So that was when you were kind of on the sponsor side of things. And then how does Next Level, to build up to where we are today with Next Level? Did you go from basically that sales side of stuff on the medical sales to that sponsorship and then to the Next Level Income? Was that the next move or?
Yeah, so Next Level Income started in 2019. So when I parted ways with my partner, we started that. I was able to continue to manage that distributorship for another year or so. Now COVID hit, so told my wife, I was like, we're going to finish building our house that she designed. She's an architect, and I'll tell you, the great thing about real estate is on paper you don't make a lot of money because of the depreciation. Tough thing is we're trying to get a loan. It's tough to get a loan when you don't make any money on paper.
You need a non-QM or something of that nature that is a little higher than par.
Yeah, exactly. So I said, hey, let me at least keep my job making high six figures, and we'll get a loan, great rate, and get that done. It's also nice when you're building a nice house for a family. You realize that like, let's say it costs $1 million to build a house. Well, yeah, trust me. But let's say it costs $1 million to buy a house. We were very frugal, so we didn't have new furniture. We didn't have like all this stuff. So you move into the house and you're like, oh, we need new furniture.
And you're not buying at Living Spaces anymore. Now you're going to Restoration Hardware. You're going to
Ding, ding, ding.
West Elm.
Yeah.
You're going to stuff that might even be nicer than those places, right?
Yeah. And then your wife says, oh, there's nothing on the walls. We need some artwork.
Well, and the other thing too is the nicer the house, there's as they say, for a new house, the backyard needs to be worth X percent if you're going to stay there long term.
That's right.
If your house is a certain threshold.
That's right.
Oh, well, actually, you can't have, this. You have to have nicer stuff. And if it's new construction with a very talented architect, you can't, disrespect the work. You got to tie everything together.
For my 43rd birthday, I bought myself a driveway. So yeah, there's all these expenses that when you build a house, you forget. You're like, oh, there's all these things that you also have to do. So it's nice. It's nice having some excess income coming in, so you can pay for those sorts of things. But I basically said, okay, we're going to build the house, make sure we got a loan, but I'll do this as long as it's still fun. And the bottom line was I wasn't having fun anymore in the medical device business. We're actually growing too fast for the company, so we couldn't get the resources needed to continue to do that. And the company was going through some cuts and lining up a merger. So I organized, and I had an organized exit from the company over the course of, it was actually 6 months total. So I worked for 3 months, and then I consulted for 3 months after that. So I was able to hand that off as we stepped out. So Next Level Income officially started, Craig, in 2019, and it grew, exponentially each year from 2019 onward.
Awesome. So then let's get into the strategy of Next Level
You're
Income.
not going to let Rob ask any questions?
I know. I was just about to ask something, actually.
Rolling,
Yeah, no. I'm letting him go. But I'm actually curious how you took the learnings from that partnership where you operated your own deals. Obviously, you still were focused on the investor relations side, but you had, I'm sure, more roles than that. So
Absolutely.
How have you strategically slimmed down your roles at Next Level to really, I guess, do more of what you like or just to be more effective?
Yeah, excellent question. I'm glad you asked that. So I think maybe the most important thing was what I learned from that failed partnership. And I learned that in business, so if you're listening, if you're watching this, you want to partner with people that have an abundance mentality. This partner had a scarcity mentality. It's like, hey, the pie's this big, I want to get as much of the pie as possible. And I'll never forget, he sent me this podcast, and he's like, listen to this podcast. I was like, oh, there's this piece and that piece. He goes, did you hear the part about how they pay investors less? And I was like, excuse me? So in his mind, he was like, how can we pay investors less money? And I remember that really bothered me. I'm like, I see your point, decrease, if you could, a more professional way to say it would be, hey, how can we decrease our cost of capital, right? So, but I didn't really appreciate how he didn't see things through investors' eyes. Because I would say, well, hey, from an investor perspective, if we can deliver, outperform on returns and give investors the best performance, then we should make more money too. And he saw it a little bit differently. So I think that's the thing. If you're building a business, make sure you're partnering with people with abundance mentality. Also, as I kind of restructured and I went from being an active manager on these deals to more of underwriting and looking at organizing the capital stack and those sorts of things, I said, what do I really enjoy? If I could pick from this slate, do I want to be arguing with somebody over a ding in a refrigerator for $50, or do I want to work to raise, say $5 million from a partner, or find a new partner in a new market that makes a lot of sense that we can bring? So I found that the latter was more not only to my skill set, but also things that really brought me more energy and did that.
That makes sense. So let's get into strategy with that said. Unless you have another question you want to throw in.
Please
I'm dominating the show here. It's really rare.
It's a rare thing.
I know. I never talk, so it's crazy. Let's get into the strategy. So you've got a couple plays you do, but love to understand your thesis and the why.
Yeah, absolutely. So if people want to hear kind of my master thesis, I talk a lot about the 18.6-year real estate cycle.
I was going to tie that in at some point, so I'm excited.
Awesome.
Yeah, perfect. So we'll bring it all up.
Yeah, so it's in episode 100 of my podcast, Next Level Income Show. So I think it's still nextlevelincomeshow.com. But you can go to nextlevelincome.com and click on the podcast link, and you can listen to episode 100, and I go through that. But to kind of be as concise as I can, the value of real estate is ultimately held in the land below it. And people say, so I had this discussion with somebody about mobile home parks in the past couple of days here. And they're like, yeah, well, a mobile home, it's a depreciating asset, so you really don't want to own the home. And I said, well, can't you depreciate a house? He's like, well, yeah, but that's different. The house appreciates. Well, what about if you buy a house that's a tear down and you tear the house down? Why would you do that? Well, ultimately, this hotel we're in, a mobile home, a house, they're all depreciating assets technically. So they depreciate, but you're getting income, and for like an apartment complex, the income is growing. Where's the value really being stored? Yes, it's the business, but it's the land that ultimately holds this value and this collateral when it comes to it. And we can get into nuances about business and all that. But if you take a house, for instance, and you say if the value is really in the land underneath of it, so I buy a lot with cash and I go to the bank and I say, I'm going to build a $500,000 house. And the bank says, we'll loan you the money to build that house because you own a $100,000 lot. So I'm able to build that house. So I built a $500,000 house. Let's say I paid $400,000 for it. I bought a $100,000 lot. I made $100,000 in profit. I doubled my money. Now I buy a $200,000 lot. I do it all over again. The real estate cycle is based on the appreciation of land, but the credit that is created around that appreciation. So as the cycles expand and contract, what we want to be very conscious of is the availability of credit. And if you watch the monetary supply, you can basically track real estate cycles and do that. So early on, as you alluded to earlier, Rob, in the real estate cycle coming out of the Great Recession, properties that are value add because it's cheaper to build, it's cheaper to invest and buy currently built properties than replace them. There's a lot of value in going in and doing renovations. Plus, rents are typically lower, relatively speaking, in that part of the cycle. And we can raise rents. So we can put in a $5,000 or $10,000 renovation and raise rents $200, $300, $400, $500. Tremendous value. As you get later in the real estate cycle, you don't have the same ability to do that. Prices are higher. So, as I looked at that, Craig, I said, okay, what are other assets, that we're gonna go into, and what are things that are gonna perform better during different parts of the cycle? The nice thing about multifamily is you can participate in development, value add, affordable housing or variations thereof during different times. You can invest in A, B, C, LIHTC deals, all kinds of different stuff. Multifamily has a lot of different things that you can do. Also debt. So as you get later on in the cycle, what we're seeing now, and this is very typical, as real estate prices rise, interest rates also typically rise, and there's more margin. It's good to be a bank at that time. So you're seeing the rise of debt funds right now. Because instead of getting a couple percent, investors now can earn sometimes double digits, in a debt fund and do those things. So I would say it may seem like I'm agnostic on the type of asset class that we invest in, but really I'm always conscious of the real estate cycle, and I look through that framework and where we're going through that, and then I try to find operators that I can partner with that can best perform with those specific assets.
So we're at that 18.5 cycle. That's how you see the world.
Yeah.
Where are we today in that cycle now?
Yeah, I think we're about 2 years away from the top of that cycle, is my personal opinion.
Okay.
Yeah.
So what does that mean then at that point, at that 2 year, at the expiration?
Are we going to see a big crash? Are we going to see an opportunity?
Yeah, I think if we look back through history. So the reason I kind of started to study this is my parents both worked in the real estate industry in the early 90s. They both lost their jobs during the savings and loan crisis. Then I saw 9/11 happen. I saw that was kind of like a mid-cycle slowdown. We saw the same thing with COVID 18 and a half years after 9/11. Crazy. Like, it's like, how do these things happen? I'm on record at the end of 2019 talking about, like, we need to be very wary going into 2020. So when I saw COVID coming out of China, I was like, this is like, I'm going to watch this like a hawk. So I got really kind of crazy into that. That's right. Yeah, the Wuhan lab. I also thought it came out of the lab very early, but anyway, so
that's probably that biomechanical, engineering
that's
and
right.
Understanding of cells and things of that nature that seemed a little bit fishy or batty.
Yeah,
some.
well, that's right. And there was a SNP from the HIV gene in there, which that doesn't make sense in nature. So I think it was in retrospect, people could kind of figure that out. But all that being said, out of the dip of the Great Recession, you move forward about 14 years. So there's typically a 4-year slowdown at the end of this 18.6-year cycle. And I don't think it's going to be the same as what we saw in the Great Recession. And if you go back to the savings and loan crisis and before that, all the way back in the 1850s, it's always a little different. So I don't know what the catalyst is going to be, but I think here's what I'm looking for. I think it'll be harder to get credit. So I think any strategies that you're going to not be able to get credit. So let's say you're in a development deal, you start a development deal, and you have to sell or refinance that deal in 2 years. I think that's going to be a riskier deal than a deal with long-term debt that has ample reserves, positive cash flow. So I don't want to try to time the market and have a crystal ball, but I think I look for deals that are higher quality, lower leverage right now. We're talking about value add. Like, I think value add deals are worth considering right now if they have outsized cash flow opportunity, like a mobile home park, which is easy to put a very small amount of capital and create a massive amount of value. But deals like we've been doing together, which you go in and you can provide an affordable option, and there's not a lot of lead time between the value you create with that paperwork versus putting in, say, 2 years of $10,000 a unit, $10,000 a unit, and then expecting to raise rents, where we're in a lot of ways actually lowering rents on the net. I'm way more confident in that.
So could that cycle ending be, frankly, the maturity of a lot of these bridge debts that have been extended and pretended? Basically, hey, at this point you were facing, we're paying the piper. We are having to exit from this deal unless you can get a loan mod or some sort of extension, or basically exiting right now. Could that be the restarting in a sense?
I think that's great insight. So if we look at this and say, okay, as I said before, if the upswing of the real estate cycle is built on credit, then the downswing would be on the reduction or contraction of credit. So if you have a property that you have to refinance in the next 2, 3, 4 years, but a bank says, hey, I got too many of these on the books, like I'm not giving you any money for it, then they're effectively denying you credit, right? So, and if they're denying you credit, they're probably going to deny the next person.
Yeah, so someone's going to be left holding the bag, so to speak.
Correct.
Yeah.
So then, what happens is, as we saw in the Great Recession, you typically see, to restore the ability to create credit, you have to get rid of the bad loans. And that actually creates some deflation in the market.
Because basically money...
Well, you're destroying capital.
Yeah, money gets evaporated.
Correct.
The debt
Correct.
and the equity, yeah.
Yep. Yeah, so prices
Paper
are
gains,
deflating.
paper losses, yeah.
That's correct. So, prices are deflated. The willingness of banks to create credit, or ability for banks to create credit, is decreased. But what that ultimately does is it clears the wreckage away. And just like we saw coming out of 08, 09, 2010, we see the next dominant companies come out of that. Facebook, Google, Tesla, all these companies, that were there before, but just coming out and becoming the next dominant players. And we also see the next asset classes and real estate. And we also see tremendous real estate opportunities during this time as well. But you have to be patient, and you have to make sure you're prepared and you have enough cash to make
Well, it's funny because we're talking about the 18.5-year cycle, and we're talking about 4 years this and 2 years that, and a lot of people, we all live in immediate gratification world, right? And so we think, oh, Fed started raising rates 2 years ago. Oh, there's going to be a crash and we're going to be able to buy distressed deals. And it's years later, and we're still talking about where's the distress and waiting for it, right? So I think there's a funny thing that it just takes a lot longer than you think, and that's to your point about being patient. It's not going to be, it's not just going to be that easy and so straightforward where, oh, okay, well, here's this and therefore that.
I had a debate 2 years ago with a mutual friend of ours at a local real estate meetup, and I said to he argued that there would be a crash the following year. This would have been a year and a half ago, and I said no. I said, and because my point was there's still credit, and people aren't going to give up a deal if they can refinance it or get credit out there. I think in the next, what we're seeing is those deals that aren't working are stacking up, and at some point people are going to have to walk away from those deals, and when they do, that's when the really great opportunities are going to be out there. So I think the lessons are if you buy a deal today, it's got to have positive cash flow. It's got to have reasonable leverage. It's got to have good reserves, and you don't want to be relying on bridge debt right now.
Right. So you want to basically de-risk, and essentially what I'm hearing, you want to de-risk, and then also you still want a dollar cost average though. Your hunch, your suspicion is, hey, just so we're clear here, for those who the light at the end of the tunnel, I guess the positive note is, you want to invest in every part of the market cycle. Mm-hmm. You probably don't want to do anything shorter, because the shorter the period is, the riskier it is. But you want to still contribute, no matter what's going on. And there's also strategies to hedge for it, kind of like, with mobile homes. That's, affordable housing.
That's right.
Our situation, affordable housing.
100%.
Hard money loans. Okay, well, you hold the paper, you hold the property in first lien position, right?
Yeah, and very low leverage, 60% leverage. The current duration, like on our portfolio, is 191 days, I think, right now, 190 to 192, somewhere in there. So money's going out, money's coming back in. Again, we're conscious of where we are. So I like to look at different deals at different points in the cycle. But also, Craig, we are always investing. But maybe we have a little bit more cash now for opportunities that are coming up. But I will say one thing I did get wrong is I think that the fact that Feds raise rates as quickly as they did a couple years ago, I think they pulled some of the peak down a little bit. So I think COVID and all the money that was injected and all the inflation.
The quantitative easing, essentially.
Correct.
Yeah.
Yeah. Again. Yeah. So I think I said this. I was sharing this with an investor a year and a half ago. I said I think that typically the cycle would kind of accelerate here in the last 2 years. I think we probably accelerated a little early because of all that monetary injection. And then ultimately, there's going to be less room for the cycle to run. Now, that being said, Trump was just elected 2 days ago, so we're in early November right now.
I know you're broken up about that.
It's been rough. That's why my eyes are so red. I've been tearing up over the past couple of years, or a couple of days. But I think undeniably, Trump is a business person. He's a real estate guy. And I think he's probably going to put policies in place they're going to enhance the economy and the real estate market. In my opinion,
there's going to be people that are going to lose money. There's going to be people that just bought wrong, and you can't outrun that. We actually had someone approach us today saying, "Hey, would you take a look at this? Like, we're just looking to get out of paper."
They're like, "Yeah, here's our loan amount, and if you could just pay us that, we are happy." Yeah. And that conversation was happening a year or so ago, but it took a while to get there. It's not like that's not the opening salvo, right? It was like, hey, we want 20 million. Well, actually, 19, 18. Well, our loan's 16, right? It was people were still clinging to yesterday's prices, but now the conversation is much more straightforward. Like, hey, this is my loan. I just need to get out. So eventually, it will get to the point where people are really actually transacting at those capital destruction levels. But another point, going back to the patience and the opportunities in the market, I think an issue that people have is they look at where prices were and that prices have come down, and they say, well, Chris, we already did have a crash. Prices are down 20%, prices are down 30%, right? That's a crash, right? But the reality is it's not really a crash because of how high they went. Oh, you could say a little bit artificially due to COVID, right?
I mean, my dad has a note in his office. He's a financial advisor, right? And he had a note, it was like dated, and it was like 2021 or something like that. I remember I called you. He's like 10-year treasury or 5-year treasury, 0%.
Like
And it was just
0.4.
Like, yeah, I was like, this is absurd. Like, wow.
Yeah.
Absolutely wow.
Yeah.
Nuts. So to your point, they should never gotten that high because they artificially propped it up due to the virus, right? And then the debt went up, which kind of corrected it slowly, and we're still kind of working through that right now. I mean, look, we're 10-year treasuries right now. Pricing isn't very good. Volatility is certainly there. So do you think, with that said, with your assumption, the changing of it, that it might not be precisely on the nose 18 and a half years, but we're kind of having that softer landing right now, that there's still some carnage, there's still some blood out there, but it's a really good time where you should be enthusiastic to invest?
Yeah. So I can't say for certain. I don't have a crystal ball. And each cycle is a little different, right? So if you go back and you look at like the peak in 07, like prices were kind of at their peak around 05. And they kind of maintained that to a degree. And then they fell, right? So, I would say that I think there's certainly discounts out there today. I think there's probably going to be some better deals in the next 4 years, but I don't think that means that there's going to be, if there's a good deal today that you can hold for the next 5 to 10 years. That's the great thing about real estate, right? Like, if you don't have to sell it and you have good debt in place and you have good cash flow in place and you have a way to create value, what does it matter? It's like a bond, right? If you're like, oh, bonds are, there's all this discussion. It's like, and a lot of people don't understand bonds. And it's like, well, if you go from 4 to 5%, you just lost 25% of the value of the bond. Well, okay, but what if I hold the bond to duration? It doesn't affect the price of the bond. I just collect the yield.
Yeah, like in real estate, you can be price agnostic if you're just enjoying the cash flow.
Exactly. So it's to answer, but also not answer the question, Craig, it's like, if it's a good deal today, but that deal doesn't transact over the next 5 to 10 years, it really doesn't matter what the market does, because if we own that deal for the next 5 years and it's a good deal for us, and then we sell it when it is a good market, then who cares if the market goes down?
And that's your focus on these not 2-3-year debt terms, but more of that 5 to 7-year term with kind of the stuff we're doing, and then also some of the other items. So you've got kind of deals and kind of where you place your money. You raise capital for about, if I'm not mistaken, 3 groups. Is that correct?
Yeah. So I have operating partners in the multifamily space. What we do in the mobile home park space, in the debt fund space, and those are spread across three main.
So can we talk about those partners who work with you? You don't have to mention names, but your thesis as to why. And then honestly, I guess just start with us. Like, what made you say yes to us? Because you're raising, for the record, one of our best raisers, and one of our favorite people as well too. But why did you choose us out of curiosity? Because we are younger guys. You do have access to really working with anyone. So I'm just curious to know what the why was. I don't think we've ever talked about that before.
I appreciate that. What's interesting is, if Rob told the story, he'd be like, it took forever but I was thinking about, we were back in, I think we were in Denver a few years ago, early, in kind of like late winter, February, March timeframe. And we were talking about some of the stuff that you had going on, Rob. And we've known each other for 5 years now? Yeah. About that? Mm-hmm. Yeah. So I like to build relationships, Craig. I like to build relationships, and I like to watch the way people do things. And I think I was talking to one of my son's lacrosse coaches this week, and he said, hey, can I ask you, like, basically, why do you like being on our team? And I said, you guys communicate. I said, the other big rival team, the coaches don't want to talk to the parents. Like, how am I supposed to help my child develop and know that he's on the right track and know how to help him if I don't know what's going on and doing that? So I really value communication. You guys are top-notch when it comes to communication. You guys communicate fantastically. You guys are consistent. So you're consistent with your behavior, your communication, the way you do things. Rob's been on the podcast multiple times. He's been a part of our coaching group and shared value with that. That's important to me. And I also wanted to see the types of deals that were being done. So, Rob, you sent me deals for years before we did it.
Yeah, you felt bad. You almost felt guilty. You're like, hey, I'm seeing these deals. I'll get back to you eventually.
Yeah, and that's how I've always done things. I always like to get to know people.
It's really smart because I think a lot of people get that lightning in the bottle feeling after going to some mastermind, some bootstrap your group, this, that. they want to get into a deal, but it's like,
Sure.
the prudent thing's probably just to wait and see
Yeah.
and go slowly into it because especially with what you do, if you do a couple wrong raises, you just maybe lost some clients and that's a problem. So seeing things play out is the prudent and wise thing to do.
Yeah. Yeah. And just like, if you're dating somebody, you're like, well, you may say, hey, this is fantastic, and I'm gonna get married, but most people date for a little while and say, hey, are we aligned? Are our values aligned? Do I like the way that person communicates? Do they respect me? Am I seeing any, because again, being burned in a prior relationship, do I see any red flags that are happening with that? And then, the other thing that really appealed to me, and you guys were talking about this earlier today during our meeting, is that you guys have really found some very valuable niches in the space. Kind of from my macro perspective, I think affordable housing is a real crisis right now. You can't build affordable housing.
No.
You just can't. People say, oh, well, we'll build affordable housing. You're not building affordable housing, you're subsidizing it. We can subsidize affordable housing. But what you all have figured out how to do is how to buy properties that are at market rate, but are below replacement cost, below what you could build at. And by providing value to the communities, to the neighborhoods that you're in, and partnering with the public entities that also realize that value, you're not only creating value for the residents and the local community, but you're also creating that value for investors. So I've not seen many groups, there are people out there doing it, but what you guys are doing in your specific markets, I think is fantastic.
So would you say that the affordable structures that we do is kind of the icing and kind of the tip over the edge just to make you feel comfortable? Because the first deal we did together was the 3-property portfolio, which is incredible timing. Maybe year 3.5-ish of the relationship. So
So the timing was great, but also so if you work with our group, we want to provide value and not just diversity for diversity's sake. So if I said, hey, I like the Texas market. I like Dallas. I like Houston. I think they're great markets, and I think they're going to continue to grow, and for a lot of different reasons. We didn't have a lot of deal flow in those areas in our current portfolio, and then again, definitely icing on the cake in terms of the affordable housing. But I would say these are value add deals without the value add.
Right.
Which is great.
Which is the best value add you can do.
I think as we were talking about earlier today, if you have a value add project that takes 2 years and you can shrink that down to 2 months or 2 weeks.
And have certainty.
There's less risk. So again, if we're going into this market and I know that as soon as you close on that deal or as soon as that paperwork is signed, that we know that value add is essentially completed, then that is a lot more certain. And that means that it's a lot less risk for investors.
Right.
So that's something that I have to look at the package I provide to investors and say, where does this fit in that package? Does it make sense, and why does it make sense? And does it ultimately bring them value? Again, going back to that lesson I learned earlier, which is if I look through the lens of is this valuable for an investor, ultimately that should be good for our business.
Right. So let's get into the other groups in whatever order you'd like to go through.
Yeah. So again, long-term relationships, 5-year relationship in terms of our debt fund and some of the other multifamily projects that we've done. I shifted from doing Class C+, B- assets with my former partner, again, early in the real estate cycle. Big value add opportunity, just like you guys saw with some of your earlier deals, to as we got later into the cycle, buying higher class properties. As you saw rents accelerate, you didn't have to do a lot of value add, but you saw cap rates compress. Those work well. Also, we have a mobile home park operator, lives in Asheville. I'm a GP on those deals, so we're buying kind of like mid-sized parks, bigger than mom and pop deals that are a couple $1 million, smaller than institutional deals that are say 20 million plus. We play in kind of like the 5 to 10, maybe even $20 million space in terms of those deals. But they take a lot more work because a lot of these parks are less than 70% occupied, which a lot of people say that's crazy. Why would you want to buy that? But we also have a debt fund arm that owner finances the homes that go in those. So we're able to rapidly increase the occupancy of these parks. Again, if we're going to do value add, it needs to massively increase the value and the income. And we know that we can do that. We test all the markets before we go in there. And
So is that by design that it's like roughly 70% occupied, so you can actually do that lift? And then is there a refi component to it after a certain period of time there? Can you walk through the mechanics and the thesis there?
Yeah, good question. So you can finance the parks whether or not they're say 70% occupied. And there's some nuances. So you want like 70% owner occupied lots, which is when you can get agency debt. So we may have a park that is 50% owner occupied, but it might be 60 or 8, even up to 80% occupied. The question is, can we go from 50 to 70% owner occupied? And that's where if you owner finance a house or a mobile home, that is now actually an owner occupied lot.
All right, so you guys come in with your financing arm and able to turn park-owned homes to owner or occupier-owned homes.
Yeah, exactly. Or take an empty lot and do the same thing. So if we have a park that's 80% occupied with 60% owner occupants in there, and we can add 10%, we can go from 80 to 90% occupancy, which is a great occupancy, but we also go from 60 to 70% owner occupied. Now we check both those boxes. So now we get agency debt, we get better debt terms, plus we get higher income for the investors. That would be an instance where we actually refinance. If we don't need to, we can just continue to drive that into double-digit income for our investors.
Does it cash flow roughly day one for investors at that 70% threshold? So then what's like the scheduling? So you have 70 to that, hopefully like the mid 80s to 90s number.
Yeah.
How long does that take? What is the dollars need to be spent there? How long are these hold periods? And then, so I guess we'll start there.
Yeah, so we have a couple different strategies. So we have kind of like the lower occupancy strategy that we are going to fill up the parks and then we're going to refinance. Then we have the parks that we're going to take at a higher occupancy and we're just going to drive the performance, drive the occupancy, and that we're not going to necessarily refi. So a park that we're going to look for a refinance or add some debt on, we're typically going to hold for a longer, say 5 to 7 year period. And we're going to look to complete those fill-ups within 2 years and look for a refinance between years 2 and 3, which is what we've done on the parks that we've done that. The other strategy, we're going to look to hold it maybe 3 to 5 years before we sell it, where we're going to maximize the income and occupancy. And there's probably not going to be a refinance component in there.
I see. Okay.
So what is the easiest and hardest strategies to raise capital for? What do your investors say, hey, I want more of this?
Yeah. I mean, I think multifamily is challenging right now just because I think savvy investors are aware the prices have come down. And some investors have been burned because their distributions have stopped, for instance. I know there's been some capital calls out there as well. So certainly if you've seen that, you probably say, hey, I don't,
Call that recency bias.
Yeah, they're snake bit.
Absolutely. Yeah, absolutely. So, or maybe investors put all their eggs in one basket, too early, or they don't have the ability to dollar cost average and do that. I think that debt funds are a little easier to raise for than they were prior because, you're looking at, if you can get 8, 9, 10% cash returns, like that's pretty good relatively speaking.
Well, it's kind of funny. We were talking about this, but I was kind of really intoxicated and enticed by this whole debt fund strategy, particularly when rates were high.
Yeah.
Oh, you can make 10%. It's probably come down a bit because rates are starting to come down, right? But then the epiphany came to me that at my age as a 30-year-old, I should probably not put my money into anything that doesn't have growth component to it because interest income right now, I'm working right now. If I was 50,
and you're paying tax on it.
Correct. If I'm 50 and I don't pay taxes, if I'm 50,
that's not what we say.
Yeah, exactly.
That's not what we say.
I pay
That's a joke.
very few taxes, very little taxes. If I was 50 to 70, I would probably want interest income in my portfolio.
Right.
But right now, it's like, okay, I'd rather just put money into the stock market, rather put money into the mobile home play because I can get some depreciation, so we have paper losses to not pay taxes, right?
Right.
And also for that income to come in where it's offset by the depreciation. So it's
we don't not pay taxes. We just defer them to pay them at a later time.
Right.
We just exactly.
Right.
It's a deferral.
Yeah. And here's a can, and I'm going to kick it down the road.
Yeah.
So that's the play there. But do you have that conversation? Is it what's the liquidity like, and do you also tailor your raising strategy and kind of your planning in a sense?
What was the last thing you said?
kind of tailor
Yeah.
who you're talking to for
Yeah.
kind of where they're at in their life cycle of their needs.
It's almost like
and
you're giving
things.
financial advice.
Yeah.
I don't give I'm not a
Not
financial advisor. I'm not a financial
And
advisor.
this isn't financial
Yeah.
advice either,
It's
by
not
the way.
financial advice.
Yeah.
But
Or
I
tax
think,
advice.
yeah, so I like to say, okay, there's really, let's say if three, we kind of play in three different buckets. So we have, income, certainty, liquidity, kind of, in one bucket. So it's like if you invest in our debt fund, you're going to get a certain amount every month of income. There's not going to be any depreciation. There's not going to be any appreciation. And you can get your money back. It's liquid. So you
What's
can
the
say,
liquidity on it?
I'm sorry?
What's the liquidity on it?
90 days or less.
Okay.
So it's not guaranteed, but we've been able to return investor funds typically within about 30 days, but we say 90 days for investors to do that. So that's the first bucket. The second is for investors probably more like yourself, Craig, which say, hey, I want some income, but I really don't care about the income, but I'd like some appreciation, but I want tax benefits. The deals that we do together are great for that. The mobile home parks are great for that. Those things are terrific. The third bucket would be, more speculative, and I don't have a great example of something that we do in that right now, but it could be more speculative. It could be the stock market. We were just talking to a colleague that was here. They're doing developments, or maybe it could be land.
The land entitlements.
Land development, those sorts of things. So maybe you're looking at say 8% in that first bucket, say 15-ish% in the second with tax advantages. So that's 15% with tax advantages is great, but maybe you're looking like 30%, doing land development or entitlements or that sort of thing. But maybe that doesn't have any tax benefits either. Maybe it does, maybe it doesn't. But there's a lot of uncertainty and there's no current income, so you're betting, a lot on that. So if you tell me, hey Chris, I value certainty and I must have this income, you're probably a good fit for the first bucket. So I'm not going to say, hey Craig, this is what you should do. I'm not your advisor. But if you tell me, hey, I got a lot of money to play with, I could use some risk, okay, go throw money in that third bucket, but then have money in the second bucket so it's growing consistently, so you can have that. And that's where we've kind of built our businesses around that, that bucket with income appreciation and depreciation.
Is there any other thought? I know you mentioned you do like the mission-driven, affordable nature of mobile homes, but what else about mobile homes do you like so much?
Yeah, so again, I think that right now, affordability is big. We have a huge need for affordable housing, huge need. So mobile homes, the supply is decreasing. So Econ 101, supply, demand. Demand is going up, supply is going down, literally going down. There are less and less mobile home parks because why? Why would there be less mobile home parks? One, you want a mobile home park in your backyard of the house you just bought? Yeah, probably not, because there's a stigma associated with it, and in some cases, rightly so. I used to work in West Virginia. I ride my bike through West Virginia, and it's 10:30 in the morning, and there's smoke coming out of somebody's backyard of their mobile home. I'm like, are they cooking meth back there? Like, what the heck's going on? There's a different demographic. However, there's really nice mobile home parks. People want a clean, safe place to live and do that. So demand's going up, supply's going down. I can buy a mobile home for say $20,000, Craig, and I can rent that said mobile home for say $500 a month. $6,000 a year on a $20,000 investment. That's good cash flow. That's really good cash flow. So the income's great. There's unlike the institutional market that we play in the multifamily space, it's the inverse in mobile home parks. Instead of having say 25% independent buyers in multifamily, it's actually less than that, I know. You have maybe 25% institutional in multifamily. It's more like 15. Mobile homes. Mm-hmm. So the final part of our play is if we can buy up 1, 4, 6, 5 parks here and there and build a portfolio of say, we'll be up to 30 parks here in Q1 of next year, we can sell that portfolio.
All 30 together, you're saying?
At a higher multiple.
Yeah,
whether that's just our parks in South Carolina or just our parks in Tennessee.
But you can bundle them, geographically speaking, and exit accordingly.
Correct. So if you are an operator that says, I want to place, say, $50 million in capital in mobile home parks, you're not going to want to buy the $5, $6, $7 million mobile home park portfolio that we just bought. You're going to want to buy a bigger park. You're also not going to fill those lots. You're going to be happy buying a deal that's say a 6 or 7 cap that you can place that capital and do that. You know, it's hard to find 6, 7, 8% cap rate deals in the multifamily space, but you know, we can buy 7 or 8 cap deals and sell them at 6 cap deals by bundling them up. Now, we don't rely on that. We actually assume typically flat or even increasing cap rates in our projections. But that's one of the other reasons I like it. You don't quite have that in multifamily. And if I may, I think there's some, you know, you look forward going back to demographics, maybe we can end on that. I'll just kind of tease that one a little bit. Yeah. So I got another asset class that I think is going to be interesting in the future.
I'd love to hear it if you want to bring it up.
So we started by saying, hey, how did I get into multifamily? We talked about demographics. I talked about the baby boomers that, you know, needed surgery. Well, that was 25 years ago, okay? Fast forward to today, so 10,000 baby boomers are turning 65, have been turning 65 every day. Your parents, my parents, your parents, Craig. My stepfather's 71, okay? In 9 years, he's gonna be 80. Those baby boomers are gonna start to turn 80 at the rate of 10,000 a day. We're gonna have a senior housing crisis in this country, is my belief, over the next 20 years. They talk about the silver tsunami. That silver tsunami is gonna flood into the real estate market. And I think we're gonna have a massive need for where we're gonna put these individuals that need help. So I think there's going to be a real opportunity there. COVID masked a lot of this because we had a lot of vacancy, and because typically you only live in an assisted living facility for about 3 years, and the saying is you move in but you don't move out.
Unfortunately, yeah.
Yeah,
it's the last home.
Yeah, but if you're losing via attrition, say 10% of your population a year, and you can't, during COVID, you know, you can't move in. So, you know, if you're at 90% occupancy, now you're at 70, it may take you a couple of years to get back there. So we're seeing that market start to stabilize. I think that's masking some of the early stages of this crisis. So I personally believe that the next decade, that senior housing, assisted living, or that area is going to outperform a lot of other areas. So I think affordable housing, huge opportunity right now. I think senior living, assisted living is going to be a big opportunity.
And one thing I'm hearing about your thesis here is there's luxury and necessity. Luxury is going to an office. Necessity is having a roof over your head. At the lowest end of the income bracket is kind of where we're specializing. Where we kind of are too. So love that. Final thing I'm going to make you talk about is your insurance life policy strategy.
Oh yeah.
I am fascinated by this, and I think this is something that we have not talked about at all. That's very unique. So please get into the strategy, the mechanics, and everything of that nature.
Yeah, absolutely. What's interesting is before I bought, or before I invested in that first multifamily deal, not even before we bought our first deal, we started our life insurance policies, my wife and I. Back in 2009, July, I found out my wife was pregnant with our first son, Ethan. And my first question to my wife when she told me, sitting there in her bedroom with the little pea stick, was, can we still go to Europe next year? Because we had this big trip planned for her cousin's wedding. I'm like, how is this kid going to be? Like, you know, we have a 2-week trip planned. I've never been to Europe before. I was like, is this even like I start thinking about the future, right? And the answer was yes. By the way, if you got a 4-month-old, that's like a carry-on. Super good age to travel with.
Right.
The next was, how am I going to pay for this kid's college? Like, what am I going to do? So I started looking into strategies, and I looked at 529 plans and all these different things. And it's like, well, what if your kid gets a scholarship? What if he decides he doesn't want to go to school. He wants to go to a trade school. What if he wants to start his own business and
be a dropout like this schmuck?
Exactly. Yeah. There you go.
Yeah. We've got two college-educated people here and 2 homeowners, but And we also own cars too, but
I'm carless, technically jobless.
Not everyone is successful.
Homeless, no degree. It's rough
People
out
aren't
here.
talking about it enough, so maybe you can live in one of the units.
And yet here we are working with this guy. Because of the business he's built.
Listen, I went to the Harvard of the Southwest, the University of Arizona.
There you go. Yeah. Does he want me to talk about the strategy or
yes,
not?
Yes.
I'm not sure. I'm not sure.
So I fell upon cash value life insurance because it has something that we can't say in real estate, which is guaranteed.
The G word.
The G word. Now, a lot of people are like, whoa, Chris, insurance isn't a good investment. So let me begin by saying insurance is not an investment. And I'll illustrate that. So the higher the IRR of the money you put into an insurance policy, the sooner you die, the higher the IRR. So nobody wants an investment to pay off because you die quicker. My best friend, he calls me, he's like, hey, what are you doing for insurance? And I told him about this strategy. This was over 10 years ago now at this point. I explained it to him. He gets these policies. His wife dies just a couple of years later at the age of 40. Now, would you go to him and say, these are for my critics that say it's not an investment or it's not a good investment? Would you go to him and say, hey, what was your IRR on your wife's insurance policy? Like that's, if you wouldn't do that, then you have to acknowledge that you shouldn't look at it like an investment. It's a vehicle, it's a tool. So I bought these policies and the intent was to save money for our children, to have money, a guaranteed amount of money, because I didn't like saying, hey, I'm going to put money in the stock market. It's like, well, what if it doesn't pay off? Well, can I access it? What if my kid gets a scholarship? What if he doesn't want to go to college? The answer to all these things was I don't know or no. And I wanted certainty for my kid's college education. So once we started these, I started to learn more about, well, what can I do with the cash value? Now, what's interesting is people know what term insurance is. It's just like renting. I'm going to rent an insurance policy for 5, 10, 20, 30 years, and you're going to pay a certain rate. And just like owning versus renting, as you know, Rob, it's cheaper to rent, right?
Correct.
Yeah, it's cheaper to rent. It's typically 30% cheaper to rent than own. But there's advantages to owning.
It might be more so now, by the way, too.
Huh?
Yeah, the gap between renting and home owning is
It's even bigger now.
Yeah.
Yeah, especially with rates where they are.
I mean, there's the haves, there's the have-nots. Yeah.
But what's one of the advantages that you mentioned earlier, Craig? You build equity, right?
Correct, yeah.
And you have control. You don't have to move. Somebody's not going to tell you to move unless you don't pay your taxes. But you got to take. There's upkeep and all this stuff. But the nice thing is, you've owned your home. You build equity in your home. Now you go to the bank and say, hey, I'd like to borrow $100,000 on my line of credit on my house. They're like, great, you can access that equity. It's the same thing with a life insurance policy. And just like a life insurance policy, while it is cheaper to buy term initially, over time, in 20 years, you're going to be paying more to rent than Craig is to own because his mortgage payment is still going to be the same, whereas your rent's going to consistently go up. So what happens is, while your payment remains flat with a permanent or whole life insurance policy, your equity also grows and your cash value grows, and you can tap that. So as you get older, the benefits accrue, just like owning. So if you understand real estate, you understand how insurance works and that value. And what's interesting is that in the early part of the 19th century, the 20th century, in the early 1900s, this was how people saved, was whole life insurance. Not until mutual funds came into play in the latter part of the century and financial advisors start to advise to buy term and invest the difference so that they could make more money, did we get away from life insurance. But what do the wealthiest families still do? They still own a lot of permanent life insurance. It's such a great tool. It's private. It's protected from creditors in a lot of ways. Ken Lay actually used a life insurance product to stash $800,000 a year, and even though he defrauded all those investors with Enron, they couldn't get to his life insurance. So that's how creditor protected it can be. So it's a great tool if you work in a high-risk environment, like if you're a doctor, you're worried about litigation, or if you're in your own business, if you want to create a private pension, those sorts of things. But as I learned about all these things, the other thing I learned about was I could borrow money against my life insurance equity, and I could buy, say, a piece of land and develop that land, build a house, take $50,000, turn it into $100,000, and do it all over again, with no money out of my own pocket. I was just using my credit on my life I was using the credit from my life insurance proceeds. I talked to my agent one year during our annual review. He goes, I love what you're doing. I wish more people would do this. And I was like, why aren't they? Why aren't people teaching them to do this? So I started to try to find people that were teaching these things, and I did find people. So what we have done is we built a product called the Investment Optimizer. So we actually take insurance and we reverse it. So instead of saying, hey, I want $1 million of insurance, we say, hey, how much do you want to put into the policy each year to maximize the cash value? And we will structure a policy that will decrease the cost of the insurance. So we'll lower the cost of the insurance. And people may say, well, Chris, how come everybody's not doing this? That's the answer. If you're selling an insurance product, you make a lot less money doing it the way we do because you're actually lowering the cost of insurance, which is how insurance agents get paid. So if you work with us, I'll actually tell you exactly what it costs to buy it. I'll let you look behind the curtain and see all that. So if you invest $100,000 of a year $100,000 a year as an investor, we'll structure a policy so you can run the $100,000 through that policy, build a policy. It'll be paid off over a specific period of time. So you'll effectively own the insurance for free, because then money goes through the policy into an investment, back into the policy. And it's a beautiful thing. It has all these different benefits. And, again, certainty, guarantees. It's private. Then when you get to the next thing, you can say, well, hey, Chris, I'm going to take my policy. My trust is going to own it. My children are going to have a guaranteed estate that's going to come to them. But just like we did, we're going to say, well, don't use the cash, in that. Use the cash to buy, say, 10 times the insurance for now your grandchildren, and then let your children borrow against the cash that's in there. So just like we do, right, instead of spending all the money and the equity that comes off of our investments, we borrow against that, or we leverage that to create more income and equity. And you can do the same thing with life insurance.
And you can't pull out for I think 7 years or so. Is that what you mentioned maybe? Or there's certain kind of lockup periods, is that correct? And how that works?
Good question. So no, the policies we structure, you can take money out of the policies as soon as 1 month after ownership in them. So what are the pitfalls? How does this strategy not work? What are the downfalls? One, there's an upfront cost. You have to pay the upfront cost for the insurance. You're getting insurance. So we'll tell.
It ain't free. No,
it's not free, but we can tell you exactly what that cost is. So there's, in the first couple of years, you're typically paying that cost. The first 2 years, from that year 3 on, you're typically getting $1 in is going to be $1 or more inside of the policy. Currently, rates are 4 to 6% tax free. So if you put $1 in, it's going to grow 4 to 6% a year inside that policy. But there is a period, so you're going to have to pay. And typically that's about a minimum of 7 years, Craig. So you can do a single pay and you can do things like that, but it's harder to do and maximize a lot of cash value. We used to be able to do that in the 80s, but people were using it as a tax shelter. So it's not a pure tax shelter anymore, but it still has tremendous tax benefits when you put it in there. So if you put $1 million into a policy over the life of that policy and it grows to $2 million, you can take out $1 million tax-free. So you can take that $1 million out tax-free. And you say, well, what about the next $1 million, Chris? You got to pay taxes on it. No, you don't. You can take out the next $1 million tax-free too. You take it out as a loan. Now, some people are like, well, it's a loan. Now you got to pay interest. Well, if I'm paying 5% interest, but I'm receiving 5% inside the policy, isn't it a wash? It's actually better than a wash because the money in your policy, just like that house that you paid $500,000 for, but only put $100,000 down, that house is compounding on the $500,000, not the amount you put in. So even though you're borrowing money out of the policy and it's costing you 5% a year, the money in the policy is going to compound at that 5%. So your interest inside the policy is going to outrun the interest you're going to pay. And the insurance company doesn't care, because when you die, that $5 million policy is going to pay off your $1 million loan, and they'll give the proceeds to your heirs. So I try to be concise, but each of these is probably a 30-minute segment on it.
Yeah, well, I just want to touch on it because it's unique, and we haven't spoke about that nature or that structure on the show. So thank you so much.
Yeah.
Final notes. Yeah. You have a book. Do you want to talk about that? How people can find you, and anything else, real quick?
Yeah. Check us out at nextlevelincome.com. You can get a free copy of our book. Check out our podcast. Learn how to look at some of these other investments. Obviously, you guys have a great resource in Lone Star Capital, and we're very grateful to be partners with you all.
Excellent.
Yeah, thank you very much.
Yeah, you're an amazing partner, better friend. Excited to have a great dinner tonight with you. Enjoy the best of Tampa Bay, and we'll have to have you on again to discuss strategy, and maybe a March edition of a BEC conversation could be next. So that'd be awesome.
Looking forward to it.
Cool. Thank you so much. For the listeners, we appreciate you. If you have any questions about Chris, reach out to me, or we'll probably put you in the show notes. If you have any questions about our deal flow, whatever's going on with Lone Star Capital, you know the email, but once more, it's Craig, Craig, @lscre.com. We'll see you next week. Peace.